This week, the market gave us one of the strangest signals of the year. It was not Nvidia. It was not Tesla. It was not Bitcoin. The asset that should have made investors sleep better is the one keeping them awake. Gold. War breaks out. Oil spikes. Fear comes back into the market. The old playbook says gold should rip higher, but this time it did not. Gold rolled over from its highs. At one point, the drawdown was close to 27%. Almost one-third of the move gone in roughly a month and a half. That is not normal volatility. That is not just a technical pullback. That is a warning. The market is telling you something very uncomfortable. The old formula may be breaking. For years, investors were taught the same simple rule. War means buy gold. Inflation means buy gold. Global chaos means gold is the safe place to hide, but the market is not trading that way right now. Gold is not being lifted by war. Gold is being crushed by what comes after war. And that is the real story. The market is not pricing the war itself. The market is pricing the chain reaction. First, war raises energy risk. Then energy pushes inflation expectations higher. Then inflation traps Jerome Powell. Then the Fed cannot cut rates easily. Then the dollar firms up. Then real yields start moving higher again, and the asset that gets squeezed is gold. Because gold has one major weakness. It does not pay you anything. No dividend, no coupon, no yield. So when the market starts thinking rates may stay higher for longer, when the dollar suddenly looks attractive again, when treasury yields start pulling capital back in, gold gets hit. That does not mean gold is useless. It means the market is repricing the cost of owning it. This is not bullish. It is a warning, and the warning is not just about gold. Gold is exposing a much bigger risk transmission chain. War, oil, inflation, the Fed, the dollar, real rates, debt pressure, demand destruction, asset repricing. Once that chain starts moving, it does not stop at one asset class. It moves through the entire market. It hits stocks, it hits Bitcoin, it hits energy names, it hits consumers, it hits corporate margins, and eventually it hits the way every asset gets priced. That is the key point today. Gold is not the end of the story. Gold is the first alarm bell. A lot of investors are asking the wrong question right now. They are asking, is gold finished? That is not the real question. The real question is this. Is gold's breakdown telling us that the market is entering a new phase of asset repricing? Because in real crises, gold does not always go up first. Sometimes gold sells off first. Why? Because in the early stage of stress, the market does not want protection. It wants cash. It wants dollars. It wants liquidity. It wants something that can settle bills, cover margin calls, and keep the system moving. When there is a dollar shortage, when rate expectations move up, when investors are forced to raise cash, even gold can get sold. That is not the same thing as gold losing its role. That is liquidity coming through the system first. But what happens after that is where the story gets interesting. If inflation does not break, if fiscal pressure keeps building, if the Fed eventually has to turn back toward easier policy, if US debt keeps expanding, then the market starts asking a different question. Can paper money still be trusted the same way? That is when the gold story changes. Gold is no longer competing with stocks. Gold is competing with currency credibility. That is why Ray Dalio keeps coming back to gold. He is not looking at gold as a short-term trade. He is looking at the debt cycle. He is looking at the currency cycle. He is looking at what happens when financial promises get too big. And the system needs a release valve. You do not have to love gold. Warren Buffett does not love gold. He has said many times that gold does not produce anything. It does not build a factory. It does not create cash flow. It does not compound like a great business. Fair point, but here is the problem. When the market starts questioning whether the cash flow machine itself can keep running, people suddenly remember the metal that cannot go bankrupt. That is not a buy signal. That is not a sell signal. And this is not investment advice. The point today is not to tell you what to buy. The point is to understand the order, because assets do not all move at the same time. Capital rotates. Money gets in line. And if you are standing in the wrong line, the problem is not always that your thesis is wrong. Sometimes the problem is that you are late. The first wave is usually gold and commodities. Why? Because when markets start worrying about currency, the first things to get repriced are the things that cannot be printed. You cannot print gold. You cannot print copper. You cannot print oil. You cannot print land. You can print dollars. You can issue more treasuries, but you cannot press a button and create a gold mine. You cannot press a button and create a new oil field. So when investors start thinking the next phase may involve more liquidity, more fiscal pressure, or another round of monetary expansion, capital starts looking for hard assets. That is why central banks keep paying attention to gold. That is why more countries are rethinking how much of their reserves should sit in dollars. That is why de-dollarization keeps showing up in market conversations. Retail traders look at gold and ask, is it up today or down today? Institutions look at gold and ask, how strong is the dollar system over the next cycle? Those are completely different questions. The second wave is usually the dollar. And this is where many investors get fooled. A strong dollar does not always mean America is strong. In a crisis, the dollar can rise because the world is desperate for dollars. Oil is priced in dollars. Debt is settled in dollars. Global trade needs dollars. Collateral moves through dollars. So when the dollar rallies during stress, that is not always a sign of health. Sometimes it is a sign of oxygen shortage. A person gasping for oxygen is not healthy. He just needs oxygen. That is what the dollar can look like in a crisis. It can rally because the world cannot function without it. But if the Fed eventually has to inject liquidity again, if real yields start falling, if the market decides America's fiscal problem is not going away, then the dollar can shift from forced strength to credibility pressure. And when the dollar weakens, commodities priced in dollars can get another tailwind. That is the second wave. The third wave is hard asset repricing. Real estate, land, energy stocks, miners, resource companies, infrastructure, anything where supply cannot be created overnight. When paper money expands, scarce assets get repriced. A lot of people think asset prices go up because the asset itself magically becomes more valuable. Sometimes that is true, but sometimes the asset is not changing. The measuring stick is changing. Sometimes houses do not rise because homes suddenly became better. Sometimes homes rise because money became weaker. That is a very different kind of bull market. Not every rally is prosperity. Some rallies are currency depreciation, wearing a different costume. If the market eventually moves into a new easing cycle, hard asset repricing may not happen in one day. It can become a long, grinding adjustment. And this is where retail investors usually make the biggest mistake. When gold and commodities move first, they think it is too late. When the dollar starts to weaken, they do not understand why. When hard assets start repricing, they finally start paying attention. And by the time risk assets start exploding, they jump in at the end. That is how people end up holding the last bag. The fourth wave is risk assets, tech stocks, growth stocks, Bitcoin, beta, names, anything that depends on liquidity and risk appetite. These assets can move fast, but they are not safe assets. They are liquidity amplifiers. When liquidity comes in, they can run hard. When liquidity disappears, they can fall even harder. That is why investors need to be very careful about treating Bitcoin like gold. Bitcoin can be a high beta asset, it can be a liquidity asset, it can be a risk appetite asset, but it has not fully replaced gold in a real crisis. During war-driven market stress, Bitcoin's behavior often looks much more like a risk asset than a safe haven. Risk cools down, Bitcoin bounces. Risk heats up, Bitcoin gets pressured. That is not gold behavior, that is risk asset behavior. And that is why the fourth wave is so dangerous. It is the most exciting wave. It has the biggest stories, the biggest price moves, the biggest thumbnails, the loudest commentary. But it is also where regular investors get hurt the most. Because by the time everything looks easy, the cycle is usually already late. Remember this. The assets that rise the fastest are often the assets most dependent on liquidity. Now bring oil back into the picture. Because oil is the key pressure point in this entire chain. A lot of people only focus on the price of oil. Oil is up, oil is down. Energy stocks are moving. But the real question is not just where oil is trading. The real question is, who gets squeezed when oil stays high? Consumers get squeezed, corporate margins get squeezed, government budgets get squeezed, central banks get squeezed. And once oil starts feeding into transportation costs, food prices, business costs, household budgets, and inflation expectations, it becomes more than an energy story. It becomes a macro story. That is the risk transmission chain. Higher oil brings inflation pressure back. Inflation pressure keeps the Fed from cutting aggressively. Delayed rate cuts, pressure valuations. Higher costs, pressure consumers. Weaker consumers, pressure demand. And that is where demand destruction begins. Not demand weakness, demand destruction. There is a difference. Consumers do not collapse overnight, they adjust. They drive less. They delay purchases. They cut back on restaurants. They reduce travel. They stop upgrading. They push off home projects. They move spending from wants to needs, from brands to bills. From lifestyle to survival, that is how demand destruction begins. It does not start as one dramatic event. It starts as behavior change. The market sees price. I see behavior. If oil is high enough to pressure consumers, if gold is falling because real rates are tightening, if the dollar is rising because liquidity is tight, if risk assets are bouncing only because short-term fear cooled off, You cannot look at those signals separately. They may all be telling the same story. The system is turning defensive. This is not a clean recovery. This is pressure moving through the system. That also explains why Jerome Powell is in such a difficult spot. If the Fed cuts too early, inflation can come back. If the Fed does not cut, high rates keep pressuring the economy. They pressure real estate. They pressure small businesses. They pressure corporate financing. They pressure consumers. And they pressure the government's own interest bill. This is not a normal policy choice. It is a trap. Cut too early. Inflation risk returns. Stay tight too long. Demand breaks. That is where the Fed is stuck. And then there is the US debt problem. The government has to pay for Social Security. It has to pay for Medicare. It has to pay for defense. It has to pay interest on the debt. And when crisis hits, it usually has to stimulate the economy to... So where does the money come from? Raise taxes? That can slow the economy? Issue more debt? That can push rates higher? Print money? That damages currency credibility. That is the brutal math of the debt cycle. At first, the market worries about growth. Then it worries about inflation. Then it starts worrying about whether the government can keep borrowing cheaply. That is when gold comes back into the conversation. Not because gold is perfect. It is not. Gold does not produce earnings. Gold does not innovate. Gold does not compound by itself. But gold has one thing that matters in a debt-driven system. It has no counterparty risk. No CEO has to execute. No borrower has to repay. No government has to keep a promise. No central bank can print it into existence. That is why gold should not be viewed only through short-term price action. Gold is a mirror. It reflects confidence in money. And right now, the question is not whether gold goes up tomorrow. The question is whether the market is starting to reassess the relationship between money, debt, and assets. If the answer is yes, then the next 1 to 2 years may not be about one stock. It may not be about one rally. It may be about the order in which assets get repriced. First, gold and commodities. Second, the dollar. Third, hard assets. Fourth, risk assets. You do not need to participate in every wave. And you should not treat this as a trade instruction. But you do need to know where you are standing, because the most dangerous thing in markets is not losing money. The most dangerous thing is not knowing why you lost it. You think you bought opportunity, but maybe you bought somebody else's late cycle story. You think you are buying the dip, but maybe you are stepping into the final liquidity wave. You think you are following the trend, but maybe you are being pushed by headlines, social media, and short-term emotion. That is why I do not want to just talk about what went up today and what went down today. There is always news. There is always a price move. But the real value is understanding the chain behind the move. War is not the endpoint. Oil is the next link. Oil is not the endpoint. Inflation is the next link. Inflation is not the endpoint. The Fed is the next link. The Fed is not the endpoint. Asset repricing is the next link. Once you understand that chain, you stop reacting to every headline like it is the whole story. Gold falls, and you do not just ask, is gold dead? Oil rises, and you do not just ask, should I chase energy? The dollar rallies, and you do not automatically say, America is strong. Stocks bounce, and you do not immediately declare, the bull market is back. You start asking better questions. Is the market pricing fear, or is it pricing rates? Is it pricing war, or is it pricing inflation? Is the dollar strong because the system is healthy, or because the system is short dollars? Is this risk relief, or is this demand destruction? Is this a short-term bounce, or the beginning of a long-term repricing cycle? Those are the questions that matter. Now, history is not a copy machine. The 1970s will not repeat perfectly. 2008 will not repeat perfectly. 2020 will not repeat perfectly. And anyone telling you they know exactly how this ends is probably selling too much confidence. Markets are dangerous because they often begin with familiar setups and end with completely different outcomes. So this is not a call that gold must go up tomorrow. This is not a call that stocks must go down next week. And this is not a recommendation to buy or sell anything. This is a map. When gold falls during war, when oil brings inflation pressure back, when Powell is trapped between inflation and demand weakness, when US debt keeps growing, when Buffett is sitting on cash, when Dalio keeps talking about gold, when the market starts debating currency credibility again, those are not random signals. They are lights turning on one by one. You can ignore them, or you can try to understand what they are telling you. The real winners in big market cycles are not the people who guess tomorrow's candle correctly. They are the people who understand where capital is rotating before the crowd gets there. So do not just remember that gold fell close to 27%. Remember, the bigger point, assets do not move together. Capital moves in sequence. First, hard money and commodities, then the dollar, then hard assets, then risk assets. Most retail investors miss the first two waves. They start believing during the third, and they usually chase during the fourth. That is the danger. At Stock Breakout, we are not here to chase headlines. We are here to break down the chain. Other people watch price. We watch behavior. Other people chase tomorrow's move. We watch the next 1 to 2 years of asset repricing, because the market does not wait for you to feel ready. Capital moves first. Retail reacts later. Your job is not to scream bull market after the final wave starts. Your job is to understand where you are standing before the wave gets there.